Hey everyone, and welcome to another Explainer. Today, we are diving deep into a topic tailored specifically for equity investors. We're unpacking the recent and honestly pretty explosive financial momentum of Actuaas Chemicals Limited, or ACL. If you're an investor looking for a masterclass in how top-line growth can perfectly pair with a pristine balance sheet, well, you're in exactly the right place. You might want to grab a notepad for this one because the numbers we're about to review are genuinely phenomenal.
We usually start these things with a gentle agenda, but let's just skip right past that today. I want to ask you a question. What does a 122.1% surge in operating profit actually look like in the real world of specialty chemicals and pharma manufacturing? Honestly, it looks like a company firing on absolutely every single operational cylinder. Let's break down exactly how ACL pulled off this staggering leap.
It all starts right at the top line. For the first quarter of FY27, ACL reported a massive 59.1% year-over-year revenue leap, pulling in 3,297 million rupees. Now, this isn't just your standard incremental growth. This is a company fundamentally accelerating its revenue engine and establishing a completely new, elevated growth trajectory. And here is where it gets really exciting, because this perfectly illustrates what happens when you scale with extreme efficiency. That revenue surge we just talked about, it translated into a headline-grabbing 122.1% year-over-year surge in EBITDA, hitting 1,131 million rupees for the quarter. So the key takeaway here is that they aren't just selling more stuff. Their growth is translating powerfully and disproportionately into real operating profitability.
To cap off these rapid-fire Q1 metrics, let's look at the bottom line. A 70.4% jump in profit after tax, hitting 750 million rupees. For equity investors, this is the ultimate validation, right? There's an old saying, top line is vanity, bottom line is sanity. Well, these numbers prove that ACL's growth is generating very real, very sane bottom line strength for its shareholders.
Of course, numbers always need context. Management's take on this? Managing Director Naresh Patel basically hit the nail on the head. He noted that this strong start, growing nearly 60% year over year, really just reflects the sheer agility of their business model. At the end of the day, it's about execution. It's their ability to keep delivering to customers on time without ever compromising on quality or regulatory standards in a notoriously demanding industry.
Section 1. Drivers behind the surge. So, what's actually fueling all this growth? We've seen the jaw-dropping results, but as focused learners, we always want to know the why behind the numbers.
When you break down their core business based on recent full-year data, you find that a dominant 85% of their net sales comes directly from advanced pharma intermediates. The remaining 15% is specialty chemicals. And within that massive 85% pharma slice, a huge driver for their medium-term growth is the ramp-up of their Contract Development and Manufacturing Organization, or CDMO arm. They're actively partnering with innovators on in-patent molecules. That is a highly lucrative space, and they've got a very healthy pipeline going.
But they're not just playing in their own backyard. This is a truly global operation. A staggering 74% of their net sales are actually exports, reaching out to over 55 countries, including major hubs like Europe, Japan, and Latin America. What you should take away from this is how this geographic diversification fundamentally de-risks the business. Because they have negligible exposure to the U.S. market, they're remarkably insulated from any sudden U.S. tariff impacts. That robust global demand mitigates localized regional risks beautifully.
Section 2. Solid financial health. We've unpacked the income statement and those revenue drivers. Now, let's pivot over to the balance sheet to validate the fundamental safety of this company, leaning on data compiled by Carriage Ratings.
First up is margin expansion. Their PBILDT margin, that's profit before interest, lease rentals, depreciation, and tax, grew from 18.39% in FY24 to 23.51% in FY25. Guys, that is an incredible 500-plus basis point expansion. According to the ratings report, this huge surge in profitability is driven primarily by a highly favorable change in their sales mix, as they lean heavily into those higher-value advanced intermediates and specialty products we just talked about. And here's a metric that should make literally any equity investor sit up and take notice. Their interest coverage is a phenomenal 38.30 times, and their overall gearing is sitting at just 0.01x. Let me reframe this in plain English. ACL essentially operates with near zero debt. That means all those massive operating cash flows,
They aren't being siphoned off to service high interest payments at the bank. Instead, that cash can be aggressively reinvested right back into the business to compound their future growth.
Section 3. Expansion and CAPEX. Speaking of compounding growth, let's shift our focus to the horizon. Where exactly is ACL deploying all this free cash? Let's take a look at their capital expenditure, or CAPEX, to see how they are future-proofing their next phase of expansion.
Comparing their two major CapEx initiatives side by side reveals a very clear, very strategic vision. Domestically, they're deploying roughly 250 crore rupees in FY26, primarily targeting electrolyte additives at their Jagadia plant to capture the booming battery chemicals market. Internationally, they are making a 200 crore rupee strategic bet on a joint venture in South Korea, scheduled through FY27, to manufacture high-value semiconductor chemicals. They are intentionally aiming a fire hose of cash at some of the absolute highest growth global sectors of the next decade.
Section 4. Key risks to watch. Look, as focused learners and diligent investors, we have to look at the whole picture. It's time to take an objective look at the structural and operational hurdles that ACL actually faces in executing this grand vision.
Grounding our risk analysis in real data from their Q1 FY27 unaudited financial results, a quick look at the expense lines reminds us of the incredibly complex cost structures inherent in chemical manufacturing. Make no mistake, operating at this scale is expensive, and margins, while currently soaring, require constant daily vigilance against fluctuating underlying costs.
CareEdge Ratings succinctly laid out the primary threats here, and there are 4 main constraints. First, this business is highly working capital intensive. Maintaining sufficient inventory gives them a long 104-day operating cycle. Second, raw materials make up about 72% of their total sales costs, leaving them exposed to sharp price volatility, even though they do try to revise export prices quarterly. Third, there's the standard execution risk on those massive CapEx projects in India and South Korea. And finally, they operate in an industry governed by stringent, non-negotiable global environmental and pharmaceutical regulations. In this game, non-compliance simply isn't an option. Section 5. The bottom line. All right, let's pull all these threads together and summarize the core narrative of today's explainer.
We've unpacked a story of truly explosive top-line growth and incredible margin expansion, fully backed by a rock-solid, near-zero debt balance sheet. But as we just saw, this is carefully counterbalanced by the very real execution risks of deploying hundreds of crores into new, high-tech chemical sectors across completely different countries. So I want to leave you with this final thought to chew on. With zero debt and soaring margins giving them maximum financial flexibility, can ACL's management team seamlessly execute this ambitious CapEx roadmap to unlock their next phase of exponential growth? Ultimately, that is the million-dollar valuation question for equity investors moving forward. Thank you so much for joining me on this explainer, and as always, keep learning.